Welcome to our YouTube live, and I've got to say it's been a kind of eventful period since the last time we spoke on one of these sessions. In the UK it's been very volatile, so obviously things have calmed down a bit now and gilt yields have kind of snapped back a little bit, and so let's say that the crisis is over for now and hopefully it's going to be a little bit more stable going forward. I mean, generally in markets over the course of the last couple of weeks, it's been pretty volatile as well. I think markets are having difficulty finding a direction. We've had some pretty worrying numbers from some big mega caps like Facebook. I saw Jim Cramer was almost in tears today. So that was pretty shocking, talking about how he got his call on Facebook wrong. But, I mean, if he cried every time he got it wrong, he'd be a wreck. But look, he's kind of apologised about it, which was surprising. But we've also got kind of tools now, which we've just added for the membership. So I just thought I'd share that because I'm kind of excited about it. Let me share that with you. See if I can actually share the right screen this time. Oh, I can't. Okay. Right, I can choose which screen I share, and I'm going to share that one. There we go. So here we have the tools, and the way this thing works is it kind of, what I've tried to do is create a bunch of monitors so that you can see what's going on in markets, but also in terms of macroeconomics, but also there are some fair value models. So I've got like a gold fair value model and a silver fair value model, and I'm going to add other stuff to that as time goes on. And then there's some macroeconomic stuff, and of course we've got stock valuations. So if we look at the S&P 500, I've got three valuation measures in here. The first one is the forward PE ratio. So if we use yesterday's close, which was 38.31 on the S&P, you can see that the because we've had this pretty big rally, we're well above the 60-year average price to earnings multiple. In fact, we're 8% above that. And we're way above the COVID low, which was an 8 times multiple, and which was a 13 times multiple. We're 20% above that, and we're about 50% above the global financial crisis low, which was an 8 times multiple. So currently, equity is looking cheaper than it was, but still not super cheap, I've got to say. And if we look at Schiller's Cape, still expensive, but that's been expensive forever. If we look at excess Cape yield, which adjusts for real yield, well, there we are looking a little bit expensive. Notice that cheap is at the top now and expensive is at the bottom, because when the excess Cape yield is low, that means that stocks are expensive. We're not kind of at the 30th percentile, which would be really expensive. We're just a bit expensive. So, we're below the median, going back over a century. So, if you adjust for real yield, the US is actually looking a little bit expensive right now. So I think that's interesting and not something that seems to be discussed much because, real yield really matters. So I think that should be something that more people look at. Anyway, switching back to me. I think volatility and, we've got the FOMC next week. I will be doing a live stream for that. And Laura actually told me to say that the reason why we're doing a live stream now is to kind of miss doing too many live streams because we're going to be covering that. And it could be interesting. I mean, the expectation at the moment is that it's going to be a 0.75% rate hike. So that's the market expectation, and anything which is different to that will either disappoint or excite markets. But certainly what's priced in now with a 91% probability is 0.75%. And then for the end of the year, 14th of December, the probability is for a 0.5% hike after the 0.75. So that'll take us to a range of 4.25 or 4.25% and 4.5%. So we'll just be getting to the point where monetary policy is quite restrictive. At least that's what the Fed thinks. That point is kind of restrictive policy. Let me also share, and in fact, let's see if I can share. Yeah, let me also share the podcast which we did this week, which was great fun. And this is Michael Pugh and I, he's my co-host, and he does incredible sound effects this time because it was a bit of a spooky one. We went for trick or treat. So we went through various asset types and subsectors of the equity market, like US small caps, Chinese equity, tips, commodities, Ethereum, and annuities, which is kind of interesting to talk about whether they're a trick or a treat right now. And we disagreed on quite a few of them. And I always listen to Michael because what he says makes a lot of sense. So you might find that interesting. Of course, the whole point of these things is not to tell you what we think, but to stimulate your own thought processes so you can come up with your own decision about whether things are expensive or cheap. So obviously, if you look over the last year, the Nasdaq is now down about 31%. The S&P is down about 20%. It's kind of interesting. I did an article in the FT, which was published today. Let me just check that it's out there. .com and Akisa. Here we go. So this is the article. I mean, the point here is to do with currency hedging, and I will be making a video about this as well. But the idea is that, if you've been a UK investor, it's just been great because our currency has been steadily weakening, and that's been the case for decades now, and that's boosted our return. So, whereas in the US, you're currently in a kind of bear market, you're down more than 20%. In sterling terms, you're not even in a correction because, sterling's been weakening and it's been kind of counteracting the fall in US equity. And even if you're a global equity investor, 60% of that is going to be in the S&P 500, or at least in US stocks. So, for us, it's been great. So now many people are worried it's going to reverse and sterling's going to strengthen. So that'll be great for US investors that buy UK stocks, which are now really cheap and really high dividend paying. And you'll probably get the boost from the currency. So I think, the kind of story's changed for the UK, which was kind of seen as a no-hoper. But I think things are starting to improve in the UK. So, let's be optimistic. Let's say it could be an opportunity. But anyway, that was what the article's about. So do have a look. And what else is to say? Oh, yeah, credit spreads. Still, not really pricing in a recession. So if we look at the single B spread, it's currently 5.0%. So, nothing like it was during the COVID sell-off. So not really even pricing in a recession where it would get to about 600, 700 basis points. If anything, it's rallied recently. So, and credit spreads have tightened. So I think the credit market is still kind of in denial. But we did get a positive GDP print. So, last time around it was year on year 1.8. And then the print we just got was another 1.8 print. And if we look at the quarter on quarter numbers, let's just change this to percent change. 2 successive quarters of negative growth here in Q1 and Q2. And then Q3 was positive 0.6%. So, everybody's talking about a terrible recession, but, when you look at the data, it's really hard to see it. So, yeah, I think that's kind of even more likely to make the Fed hike aggressively. So, the economy seems to be in pretty good shape and the jobs market seems to be red hot. So, I can see a lot of reasons why people expect the Fed to carry on being incredibly hawkish. Anyway, so that's, I think, why markets are kind of freaking out. And of course, with big mega caps like Facebook essentially destroying itself by pursuing this bizarre dream of the metaverse. It doesn't you've got to have focus in these markets. You can't just pursue these pipe dreams and not, bring home the earnings bacon, as it were. So it's not really surprising that they've been so heavily punished. But what's worrying is that they're such a large constituent of many indices. So, or at least they were. So I think that's pretty shocking. Anyway, so I think that's the kind of background to markets right now. And switch back to me. And yeah, so the way this works, we'll have an hour together, now 45 minutes. And then just ask a question, and we will favour people who support us on YouTube. So we'll be able to tell you're one of our YouTube supporters because you have a little crown next to your name. If you want to see those trackers, you've got to be a member of our community on our website, PensionCraft.com. So if you're interested in joining us and becoming part of our community where we all kind of learn together and discuss markets together, then you have to go to PensionCraft.com and join our membership. You get the trackers, you get Slack, and you get a call like this, but it's every 2 weeks, and it's much more likely I'll answer your question because, there are only about 30, 40 of us on the call. And overall now we've got about 800 members globally. So, and they're from everywhere. A lot of UK people, but a lot of US and other English-speaking countries, and even some non-English-speaking countries. We've got members from those countries too. So do join us, and it's lots of fun. And I think the kind of community is very supportive. So, if you're freaked out about your portfolio, you're worried about rising rates, what the Fed's doing, I think it's nice to have that accountability with like-minded people who do have a kind of long-term mindset. So, yeah, do join us. It's fun. And now I'll answer some questions. There we go. So, super chat from James Patterson. Thank you very much, James. And he says, opinion on UKW, trading at a rare discount to NAV currently. So let's take a look at it. UKW. So this is a single stock. I don't usually invest in single stocks. I'm not the perfect person to ask about this, but still, I'll give you my opinion. So here we go. And so first of all, it's an ordinary share, so it trades on the London Stock Exchange. Its revenue comes 100% from the UK, and its turnover is about 400 million. So not a huge company. Certainly by US standards, it would be a tiddler. But if we look at the income, you can see that it has been profitable, and the earnings per share in 2021 were pretty good, higher than last year, for example. Took a bit of a hit in 2019, and yeah, so it is profitable. The profits seem to be a little bit volatile, but okay. If we look at the summary here, we can see the distribution yield's 5%, so it's paying a pretty high income. The expense ratio, that's interesting. So it's a closed-end, so it is an investment trust, and it's pretty expensive, so it's charging almost 1%. So let's have a look at its portfolio. Okay. Well, we can't actually see what its holdings are. Oh, interesting. So it's pretty opaque. I can't see what's in it, but in terms of the returns, it's had a bit of a rough patch, clearly. But I guess some of it might be the fact that it's got UK exposure. But obviously, the kind of impact of the price cap is negative for UK renewable energy generators. So if it's getting its energy from UK wind companies, and I'm guessing that's the thing from the name, I don't really know what wind assets it's got. But if that's the case, then they have had a negative impact. And a lot of people from the industry are warning that impact is very odd because gas-fired power generators are not facing the same windfall tax, which is quite odd. I mean, why would you punish your electricity generators which are renewable relative to the ones which aren't and which are generating it from burning gas? It seems a little bit of an odd way to do things, particularly if we want to be self-sufficient, because wind is something we've got plenty of and which we can generate domestically, and gas strategically has proved to be a problem. It makes us dependent on other countries. So I'm not sure about that policy. Perhaps that'll change with a new government. But maybe that's the reason why, it's been quite volatile, the price, over the course of this month. But yeah, I mean, I don't invest in single stocks, but I would like to invest in something which is renewable. And one of the things on my market crash shopping list would be a clean energy fund. Certainly a battery fund is on my list because that'll benefit from the shift to renewable energy. But for this particular stock, I can see it is trading at a discount to NAV. That's the green line you can see here. Not a huge discount, it has to be said, but a slight discount. But would I be buying it right now? I think I'd like to see more clarity on that windfall tax, because it might mean that the company has a fairly big impact on its revenue if suddenly it has a windfall tax slapped onto it. So yeah, let's hope that doesn't happen if you've got big exposure to this, James. But anyway, thank you for the question, and thank you for the super chat. But single stocks generally I wouldn't invest in, but I can just kind of give you my top-down view. I don't know if that's helpful. Right, so I'll move on to your questions now. And don't forget, if you do support us on YouTube, then we'll push you to the front of the queue with a question. We'll be able to tell because you've got the crown next to your name, the PensionCraft crown. And if you super chat also, we'll push you to the front of the queue. Ned Flanders, nice to see you. Okay, so but first question is Antonio Peinado Leon, who says, lack of growth, high debt to GDP ratio, who are we talking about here? Aging population, decrease in productivity, populism. How are governments going to carry on paying their debts? Yeah, I mean, people freak out about this often. And let me just switch back to me. Yeah, I mean, everyone talks about debt sustainability, but really remember the critical numbers that matter. So is the debt servicing cost greater than growth? If that's the case, then yeah, you've got a problem. If the debt servicing cost is slower than the growth, and in percentage terms, then the debt's not going to grow uncontrollably. So as long as you can grow your way out of the debt problem, if your GDP is growing faster than your debt, then it's not a problem and it's sustainable. Now, obviously people are spending a lot, governments are spending a lot right now because of some of them are doing handouts for their citizens. France is, Germany is, in order to get them through this winter and through the energy crisis. But that's a necessary expense, and I think it won't go on forever because there will be a strategic shift away from these resources which come from Russia, for example, and a switch to alternatives. There's new infrastructure to ship in LNG to Germany, for example. That's been very rapidly created. So I think, I wouldn't be too gloomy about the prospect of paying off debt to GDP ratios, or paying off GDP, paying off debt, because, I mean, we're still not at the kind of runaway debt stage in developed markets. That's not true. So decreasing productivity, that is a big deal. And, one of the good things about Liz Truss's growth plan with Kwasi Kwarteng was that they actually addressed the growth problem and admitted there was one. I'm not sure they had the right policies to address it, but at least they were trying, and they acknowledged there was a problem. But I think productivity growth is a real problem. Inequality is a problem because that itself decreases productivity. if you've got huge accumulation of wealth and a small minority of the population, then very low wages for a large proportion of the population, well, that's not productive. I mean, by definition, if wages are low, then productivity growth is low. So, I think inequality is a problem. So, but very few politicians are addressing that right now, and few political parties are brave enough to admit that's a problem or come up with policies which would address it. So, yeah, I think you've identified a lot of the problems, but debt sustainability, I don't think, is one of them right now. And particularly after what happened in the UK, I think countries are much more aware of looking to be fiscally responsible and not to have an unsustainable debt burden. So I think that's less of an issue than it was, because everyone will say, "Oh, don't do a Britain," don't do a UK. Okay. I just saw a super chat. Thank you very much for that. Laura will tell me what it is, I suspect. Zahir Jamal, thank you very much for that. And we've got one before that, actually, which I'll address. Just have a quick swig. Right. So Paul H, who's one of our supporters. Thank you, Paul. I can see the nice crown next to your name. He says, do you have any insight on how much the Fed's rate increases will hurt the house sales in the US? Timing of any downturns? Well, we've already started to see house prices, not in aggregate, come down, but the acceleration or the rate of increase has decreased. So if you look at the Case-Shiller index, it was going up at 17% per year, or 19%, I think, since the COVID recession. Now it's started to level off and start to fall. I think it's like 12% year on year for Case-Shiller. But how much will they hurt house sales? Well, the good thing is in the US, you have 30-year mortgages, and that's going to cushion the blow for some time. The second thing which the US has in its favour is more rapid wage growth than in the UK, say. So, that's what the Fed is a little bit freaked out about, is the rate of wage growth. Still negative in real terms, still less than inflation, but still not consistent with a 2% rate of wage growth. So if that's the case, then remember what sets this kind of sustainable house price growth rate is wage growth. And, so the fact you've got pretty good wage growth in the US will cushion the blow. 30-year mortgages will cushion the blow because you can just stay where you are. Certain people will have to move due to, a relative passes away or they need a bigger house because they've got new kids. So, certain people have to move, but it's a choice for many people. So you can just stay put. And so I think that's going to cushion a lot of the blow. But we've seen supply also start to fall in the US, and that'll also be a support for prices. So all these kind of tales of Armageddon, I think, are just nonsense. I think there will be a soft patch, falls, sure, but will it be catastrophic? While supply remains limited, and obviously there's huge regional variation in the US, just as there is in the UK, but if there is limited supply, you've got 30-year mortgages, and funding costs are still relatively low. I mean, they've certainly been higher in the past. I've seen the 30-year mortgage rate went above 7% for the first time in ages. So that will be a shock for people who have to remortgage. But fortunately, if you can stay, it's not a problem. But in terms of what kind of impact it's going to have, what we're planning to do is to put the valuation tools, which we have for the US and the UK housing market, onto the trackers on the website so that people can see the latest forecast. But for the US, I did a forecast recently, and because of the wage growth being pretty good, as long as there isn't a huge mean reversion for the price to income ratio, I think prices could, not fall too much. We're talking about 5%, 10% corrections. But then The places where they've gone up in a crazy way, like Phoenix, for example, has had huge price growth. There, I think we're kind of more exposed, and there the corrections will probably be bigger. But look, you'll know in your local area where the prices are kind of crazy. But remember that what drives house prices over the long run is wages. And if that price to income ratio has got way out of whack, that's where the reversion will be biggest. And you'll know in your area what that's like. You'll be able to see it. But overall, for the US, I don't think it's going to be a bloodbath. I don't, because of the reasons I said. Similar for the UK, undersupply, but of course we've got the huge problem with increased mortgage rates. And here we don't have 30-year mortgages, we have 2-year and 5-year fixes. So for us, it's probably going to be worse. And our price to income ratio is the highest it's ever been. It's about 7.1 times. And there's still no sign that that's come down a lot. I mean, it's still growing year on year by almost double digits if you look at the nationwide house price survey, the last one anyway. So we'll just have to see how it turns out. But I just wouldn't believe the kind of doom stories and the kind of doom porn that you see on YouTube, because that might get clicks. But I think it's, except for those certain regions where it's hugely overpriced, I think it won't be too bad. So the super chat, thank you Zahir, is it was in Rand, interestingly. Is there any good reason to think, with good in capitals, to think that inflation will cool after December, when real rates are likely to still be negative? No lockdowns ending. Not lockdowns ending. Why would inflation cool? I guess we're talking about the US here. Well, if you look at the components of US inflation, it's kind of interesting that a lot of the things which drove things up, energy, haven't gone into reverse yet, but the acceleration, the rate of year-on-year increase has fallen hugely. So let me just see if I can find a tweet which kind of shows that's the case. Because when there's a US inflation number, I try to break it down into the components. But if I can't, US CPI, I'm guessing. And I'll get the most recent inflation. Yeah, here we go. September. I thought I did one in. Okay, I didn't do it. Okay. But certainly if you look at energy prices in the US, so let's get gasoline prices in the US. I'll just share my screen. And we'll get this on Fred. So this is US gasoline. And this is the US gasoline price. And let's just look at the last 5 years when we've kind of gone crazy. And instead of dollars per gallon, let's look at the percent change from a year ago. And you'll see what I mean. So remember, this was the primary driver of inflation on the way up. And year on year, it peaked at 66%. And that was in April of last year. And it stayed high, right? It had this triple peak kind of thing, year on year. But then since the peak in June of this year, it's certainly fallen a lot. The rate of growth has fallen. So the rate of growth as of the 24th, that's 3 days ago, year on year, was about 10%. Now this hasn't gone negative year on year, but I wouldn't be surprised if it did. So let's go back to looking at the actual price in dollars per gallon. So could this fall negative year on year? Yeah, I think it's quite possible. Because last year it was very expensive. So we're already getting to the point where we're moving past such that, we'll kind of be comparing with a base value which is very high, and so we're very likely to see year-on-year falls. So what was pushing inflation up is going to start dragging it down. If you look at things like shipping costs, again, those have come down a lot. So a lot of the supply chain stuff has gone away. If you look at the chip supply, one of the side effects of very high energy prices is that people aren't using chips to do cryptocurrency mining. So that market has essentially collapsed. And that in turn means that things like chip shortages are likely to abate. And that was driving a lot of the second-hand car year-on-year increases. Remember, that was the other big component of inflation. So now what we're moving to is shelter. So if shelter starts to peak, I think that's going to be the point at which things really start to turn around, because energy will already probably be falling by then, and will also have the effect of the supply chain bottlenecks easing and the chip shortages disappearing. So I think a lot of this is likely to go into reverse. So let's just hope that that does happen, because it's incredibly painful for people, I know, when inflation's at over 10% and their wages are growing at 4%, 5% in the US. So yeah, I think it's critical that the Fed does get this under control, but let's just hope that does happen. Let's have a look at the I think I've got inflation breakdowns here, or maybe I didn't add it. So this is US inflation. Yeah, so 8.2%, and then the core is something like 6 point something. Just zoom in a bit. Yeah, so core is 6.7, and then CPI headline is like 8.2. So I think a lot of that is going to go into reverse, but we'll just have to see. And even the Fed's admitting now that it can't forecast inflation. So but I think those are the reasons why I'd expect to see it fall. So I kind of, I think people are just a little bit too set on the idea that inflation's here to stay. I think that's not the case. I think it is going to fall, and I think a lot of the drivers which pushed it up have now dissipated. So I think it's just a matter of it working through the year-on-year comparison period, and then we will see things start to fall. I mean, the one worrying thing is the ban on chip exports or chip technology exports to China, which could have kind of a secondary effect of creating another chip shortage if China retaliates, when China retaliates. So that could be a worry. That could create another shortage, but we'll have to see how that one pans out. So anyway, I hope that gave you some hope, Zahir, that we will get inflation under control. Right, so don't forget, do like us. Please do like the stream, even if you're watching it in a replay, and please do subscribe to our channel, because we'd love you to see our content. We do our best to make it interesting and fun. It's fun. It's not really fun when markets are falling, but it is fun to talk about it and be engaged and learn about stuff, and that's what we're here for. So do subscribe to our channel and like our content and share it with your friends, as many people seem to now do, which is great. So next question is from Martin, who says, inverted yield curves are a sign of an upcoming recession, but many countries are already in one now. What's your take on this, Ramin, and expectations of the stock market in 2023? Well, obviously, I've made videos about this, but look, I'm getting more bullish. I'm starting to get greedy, because when valuations come down to fair value, it's still not cheap in the US, but there are pockets of cheap, right? So in my recent video about my market crash shopping list, one of the things I like is US small caps, because they are looking very cheap. So, maybe that's something to think about. look for other pockets of cheap as well. It's not just one global market. You know, there are pockets of value everywhere. But certain things aren't cheap yet, like US equity in aggregate, the S&P, not very cheap. You know, if you adjust for real rates, as we saw. Small caps are, small cap value is probably as well. That's a real good banger. You know, from the if you look at historic returns, small cap value is the real trooper, and it's just had an awful time, and it's looking very cheap and very unloved right now. Surprisingly enough, long duration US Treasuries, you know, they're very unloved. Yields are pretty high, and I think inflation, if it does surprise on the downside, also if growth surprises on the downside, you know, both of those would push up bond prices, and so that could benefit long duration gilts, for example. But you know, what would I say about recession? Well, the US doesn't look like it's in recession. So, you know, we had 2 quarters of negative GDP, but as we just saw, we just got a quarter of positive growth. So the Fed is kind of being very aggressive because it thinks the US can bear the nasty medicine of higher interest rates. Can other countries stand that medicine? I think it's less likely. So the ECB today raised rates by 0.75%. I think some corners of the Eurozone are going to have real trouble with that. You know, you look at some of the Eastern European countries like Estonia, Latvia, and, you know, you're thinking, well, they're facing inflation of like 20%, and they're now seeing interest rates increase quite aggressively. You know, are they going to do okay in that kind of environment? Probably not. So I think in pockets in Europe, there's going to be problems. But there are lots of positives. For example, a very mild set of weather in Europe. So gas reserves have been built up. So I think I wouldn't say we're past the crisis in Europe for gas, but it's certainly looking more positive. And there has been an agreement in the EU to use their collective buying power to make sure that the cost of energy isn't too high. Now, there's obviously a bit of a fracas between France and Germany. Hopefully, they managed to patch over those difficulties this week. There was a meeting, I think, between leaders. I think it was today, actually, where they tried to soothe a bit of a dispute. But still, I think that agreement by the EU is a big positive. So I wouldn't be too gloomy about things. I certainly think that we're going through a weak patch of growth. But are we going to see a full-on recession in the US, a deep one? I think it's unlikely. Even in the UK, I don't think it's going to be a very deep recession. So if you look at NISA's forecast, for example, they're not forecasting a deep recession. The Bank of England also, not a deep recession. Just a kind of shallow, 4 quarters of growth, which is just teetering on the edge of zero, which isn't great, but it's not a catastrophe. What really hurts is the inflation, right? Let's just hope we can get that under control, because that's what really destroys people's lives. If you can't afford to heat your house or feed your family, I mean, that's real hardship, right? But let's hope that kind of abates fairly quickly, which I suspect it will. Certainly by middle of next year, end of next year, I think we'll be well past this hump in inflation. So fingers crossed, right? But nobody really knows. It's very hard to forecast these things. But I'd worry more about inflation than growth, I'd say. Next question is from Ned Flanders, who says, "Hey mate, do you think roughly speaking we've reached the bottom now? No more crazy fear of going down another 30%. Well, it really depends on whether there's a kind of secondary crisis now, I'd say. So what often happens is that when you get a market correction and interest rates start to rise aggressively, it kind of shakes all the bad apples out of the tree. And some of the bad apples are really big, like WorldCom or Lehman where people have got too much leverage or there's an accounting scandal, and that kind of roils markets again. And you can see how jittery markets are right now with the Facebook sell-off of 20% in a single day. So if that's the case, then, if you do have these accidents, big accidents, then, that can really start a kind of chain reaction. So that would be my worry. But all you can really say now is that things are reasonably priced. All the crazy's gone out of the market. We're back to the usual situation where you have to look at value, look at multiples, look at fundamentals, because they matter again, as we knew they would. And when everybody was saying, oh, fundamentals don't matter anymore, that really worried me, because when people say that, fundamentals matter most. So people are now looking at valuations, they're looking at profits, and companies which can't generate profits, or which have too much leverage, or maybe have a small interest cover, that's another red flag to look for, are going to struggle. So, maybe a tilt to quality in this environment would be a good thing, because there you have got a filter usually for leverage, but also steady earnings growth, good return on equity, sound balance sheets, all the kind of boring, sensible stuff which works over the long term. But another 30%, not unless there's an accident, I'd say. But is equity cheap now? No, not in the US. In the UK, it's very cheap, but, we know the reasons for that. And in Saturday's video, I've got to say, I've done a bit of a sales job on the UK. I mean, it wasn't deliberate, but, I was thinking about it and I thought, yeah, for a US investor, it kind of makes sense now. Because you get the kind of high income, low valuation, plus the potential for sterling to strengthen, all of which would help you as a US investor. So we're not uninvestable anymore. Woohoo! In the UK. Right. How are we doing? Let's have a look at Laura's sheet. Oh, we've got a super chat. And I know Laura would tell me to say, please like our stream. And if you're watching it in replay, also like it. It helps us. Subscribe to our channel. Join us on PensionCraft.com. And you'll have access to those funky tools, which I'm expanding all the time. Brilliant. Okay, so the super chat is from Richard Watshie, who says, it says, me again. Have you seen that the US 10-year 3-month has inverted? Yes, I saw that today. This is the inversion the Fed actually pays attention to. I think we may see long-term yields come down as flight to safety. I hope so, because one of my market crash shopping lists, which I've actually activated already, was a long-term US Treasury, long maturity US Treasury, long duration US Treasury fund. So, I thought that, we'd have a bit of a flight to safety, or inflation would surprise on the downside, or growth would surprise to the downside, all of which would have helped long duration US Treasury rally. But we haven't really seen much sign of that. But the inversion, another thing to look at is this model from Kylie, not Kylie Minogue, right? Not that one. Okay, so here we go. This is the US recession model. And this was published a while back now, but I kind of took the inputs from Fred, and now this updates regularly. And because it's got credit spread in it and term spread, it kind of updates on an almost daily basis. But certainly the last time I updated it, you can see that the probability of a US recession in the following year has fallen from the peak, which was around 80%, to just 70%. But it's still pretty high. And this is looking 1 year ahead. It's not a perfect model. It's pretty good. It's not amazing. You can see the actual recessions were shaded blue here. And the forecast of the model for the following year is in kind of dark blue. And you kind of got a false positive here that was a bit early, and a false positive here, 98 I think that was. But generally it does a pretty good job. It picked up the COVID one. But currently, no recession as yet. So still positive GDP, and we haven't seen the recession really kick off. But still, it's kind of flagging a worrisome probability of recession. So yeah, I think I pay more attention to that. But one of the things which goes into that model is term spread. I can't remember which tenors it uses, but is it 3-year and 10-year? I can check, but I can actually pull the code up here. Just talk amongst yourselves. Okay, here we go. So, what is it? This is macro monitor. And here we go. Which ones are we looking at? I think it's definitely, yeah, so it's 10-year and Fed funds. So really short, right? So Fed funds versus the 10-year. So that'd be similar to 3-month 10-year. And yeah, so that inverting is going to push that probability back up. Inflation will push it back down. The unemployment rate actually is flipped. It's not the sign you'd think. When unemployment is low, it actually increases the probability. So if unemployment does start to rise, it'll reduce the probability. And then the final thing is a term spread, which, when it inverts, it increases the probability of a recession, and high inflation as well, of course. So yeah, certainly at the moment, it's still looking pretty scary. That's what I'd say. But the inversion, yeah, that's worrying, I've got to say. Good question. Richard Perring. Why doesn't Michael from the podcast ever join you on the live shows? He could. Yeah, Michael's welcome to do that. I think he's a bit camera shy. I don't think he likes doing it, but he's brilliant on the podcast, absolutely brilliant. And, I think he adds so much. It wouldn't be half as good if it was just me, right? I think Michael's brilliant. And he's learnt so much, and he researches it so well. And he has really interesting opinions of his own. So I wish he did join us. Actually, it would be great if he joined us for the live stuff, but maybe in future. Interesting comment from Musicful. He says, when a stock is down over 70%, like Meta, I strongly doubt it can recover. Yeah, I mean, it is shocking, isn't it? A company that was so successful until recently, everybody's darling, really. I mean, fund managers there's a really popular fund manager in the UK called Terry Smith, and he was buying lots of Facebook at one point. Obviously, he got burnt with that. And, so even really good investors get sucked in to the narrative. But, the Meta thing, I think, has really upset a lot of people. And watch Jim Cramer crying. You'll see it on Twitter. It is pretty shocking. How are we doing? We've got 10 minutes. We've got a question from Jacques Lemasson, who says, hello, Ramin. When you say you're buying long-term US bonds, you mean gilts or bond ETFs? Yeah, if I could have bought single gilts in the UK, I would have done. But I've got Vanguard and I've got Trading 212 as my broker. Now, if I had Interactive Investor, I could have bought single gilts, but I didn't. And I was saying to Laura, I'm going to open an account with Interactive Investor, but then I didn't, and I should have. And I think I've kind of, well, not missed the boat, but I think it would have been better to do it, say, a couple of weeks ago, 3 weeks ago. But still. But what I bought was an unhedged US long duration treasury fund. And it was a fund, it wasn't single bonds. So, yeah. But anyway, in the UK, what I probably would have gone for was one of those 1, 2, 3 year gilts. where I'd never have to sell it. I could just lock in the yield of 4% and just wait till maturity. You know, that would have been what I'd have done. But, you know, I didn't. Perhaps I should have. Regrets. There we go. So I hope that answers your question, Jack. And back to your questions on YouTube. What have we got? Dmitry Belyakov says, yay, good times. Hi, Dan Trainer. Finance, food and free time. Hello. Nice to see you. Music full, we answered. How do you think QQQ will perform over the next 10 to 20 years? Oh, good question, right? Yeah. So obviously QQQ has had an incredible run. Incredible. But one of the things to watch out for is the ratio of QQQ to NASDAQ. Oh, sorry. The ratio of QQQ to SPY. So NASDAQ to the S&P 500. And that ratio was getting crazy high. And that was a red flag, right? I mean, it was clearly getting a little bit out of whack. Because 50% of NASDAQ at one point, the NASDAQ 100, was made up of those, you know, mega cap tech stocks. And that was just a ridiculous concentration. And inevitably, the way that always ends is that there's some kind of shakeout, earnings disappoint, and the market cap shrinks for those really successful companies. And sure enough, that's happened for most of those mega caps. So I think the problem at the moment is that, you know, now it's down 30%. Is it looking cheap? Probably not. You know, it's still not looking cheap. If you look at growth's premium in the US, it's still pretty big. You know, people are still paying a pretty large premium for growth. It's roughly the same as it was about 2 years into the dot-com bubble bursting. The valuation, the additional valuation, forward valuation for growth over value. But then what happened in 2003 was that gradually it kept on shrinking. So the premium people were paying for growth kept on shrinking until it shrank to almost zero in 2008. Only after that did it start to go crazy again and blow out as people were filled with enthusiasm about tech and its transformative powers in the world. So I think that kind of party, you know, is probably a long way away. But a lot of the companies which, I mean, if you love tech stocks, then, you know, there are lots of bargains out there. My way of exposing myself to that growth story, not just in the US, but globally, is via Scottish Mortgage. So that's on my market crash shopping list. I'm going to buy some of that, right? It's got to the point where it's looking attractive. So I'm going to buy some of that myself. But that's kind of like Cathie Wood, but with more governance. So if you took the crazy out of Cathie, you'd end up with Scottish Mortgage. Not that she's crazy. I mean, she's a good fund manager. She's just had an awful time, I think, with her choices. And also her risk management, I think, was very bad. The people around her should have given a bit more pushback on some of the names. But, you know, she never backed off her primary thesis, which is looking for disruptive stocks. But the question is, what price do you pay for those? And I think that Scottish Mortgage has got a better handle on that, and they're more careful with their risk. But, you know, they got burnt as well, as did any growth manager over the last couple of years. Comment about Teddy, my dog. Is Teddy hoarding friskies, or is he waiting for cheaper market conditions? Yeah, well, you know, Teddy gets upset, you know, if there is a poor market mood, because, you know, it affects me and it affects him indirectly. But, you know, I think he's just waiting to invest at better valuations. I think that's what he's planning to do. He keeps himself to himself. He's quite secretive with his trading strategies. Mr. Zween, what do you think about private equity right now? Oh, right. Sorry, I've just got to switch because we've only got 4 minutes and I've had a super chat from Richard Watts. Thank you, Richard. He says, This is just to say you absolutely must get on Interactive Brokers. You can do lots of YouTube content with it also. Okay. I mean, I'd only do it because it has some of the stuff I'd like to buy, but I don't usually talk about platforms. You know, we do get approached by a lot of platforms to do advertising, but generally we don't do that because there's a bit of a conflict of interest. And, you know, frankly, a lot of our best content is not platform reviews. A lot of people can do that. It's about market insight and education about markets and economics and macroeconomics and how it affects investments. So I think, you know, we probably wouldn't talk about the platform, but I might talk about the stuff I buy on there. You know, that's what I do. So switching back to the last question. Dan Trainer says, is premium membership appropriate for a US person? Yeah, we have several people from the US. Yeah, so it's not UK specific content. And we do have people from all over the world. And you can probably tell I talk about US markets more than I talk about UK markets because they're so important. And my background was as a global strategist. So the US was my focus always. So, yeah. And I think the kind of focus of the group is very outward looking. So it's not parochial in any way. So, yeah, it's for US investors too. Someone else saying that we should do a live show with Michael Pugh, my co-host for the podcast. So, okay. Tritax Big Box is doing rather nicely this week. Yes, at last. That's good. That's one of the things I bought in my market crash shopping list, and I'm going to buy some more of that, I think. And somebody saying, is PensionCraft worth joining? Obviously, yes. Interesting question from Newtonify, who says, we've got another super chat from Stephen Roberts, who says, unsure if I should stay in UK fire service pension. Will DB pensions, defined benefit pensions, exist in 30 years? I think for new members... Oh, Laura's saying something downstairs. We've got one more. Okay. Will DB pensions exist in 30 years? I think they'll close them to new members, but I think DB pensions will still exist, you know, for the members who are already there. I think you might get some very attractive offers to switch it away from defined benefit because, as we saw recently with all the LDI fiasco, these are funds which are difficult to maintain. And DB has become very unpopular because it can be expensive for the company, which, remember, it's companies that do this, or things like the UK Fire Service. I didn't realise it was DB. But it is difficult to maintain these funds. But will it still exist in 30 years? If you've got it now, they'll have to honour it, probably. It's very likely they will. But will it be open to new members? Almost certainly no, would be my guess. But should you stay in it? I can't advise about that. I don't know your circumstances, Stephen. Next question is from Adrian Cook, who says, does QYLD look attractive now? Well, I mean, volatility's high for the NASDAQ, so that's going to push up the income on it. And the problem is that if the NASDAQ does really strongly rally from here, Adrian, then something like one of these QYLD funds, which have sold the upside, will get less exposure to the upside. So they'll underperform in a very strong rally. So if you think the NASDAQ is about to tear upwards, then QYLD, not so good. If you think it's just going to bob around its current level with high volatility or even fall further, then QYLD would be a good choice because you're monetizing the high vol and earning about 12% last time I checked in dividend, which is incredible for the NASDAQ. Yeah. So I hope that was useful for you all. Thank you for all for joining us. Don't forget to like our content, and don't forget we've got our PensionCraft tools now, and I think they're quite good, and we will improve them and add new stuff as it comes available. And I just hope everything works out for you in markets. It is a difficult time. Just remember that when markets sell off, it's a bargain. It's time to buy, not to sell. And don't forget that we're going to do our YouTube live in a week's time, just after the Fed's meeting, just to talk through the consequences and also translate the Fed speak into human speak and what it means for investors. So thank you all for joining us. It's been great to have you for an hour, and hopefully we'll see you again next time, or maybe in 2 weeks' time. Take care, everyone. Bye-bye. Oh, I should have said the Fed is in a week's time, not 2 weeks' time. Okay. Bye, everyone.